The Rebel Capitalist Show. So you came out with a report or a blog post the other day that just completely blew my mind. I've interviewed guys like Brent Johnson, Luke Groman, and they all have a much different view on the dollar. But in this report, you kind of laid out some of the cross currents, which I thought were really, really interesting. Can you kind of go over that report and then let's kind of dive into it?
Sure. Yeah. So I have a couple different reports on the topic, like each one kind of approaching it from a couple different pieces, like different parts of the puzzle. The main crux of it is that there is a global dollar shortage, which
Right.
both Luke and Brent and others have touched on. Um, and so that consists of a bunch of things, but as the BIS states, it's 12 or 13 trillion dollars in dollar-denominated debts outside of the U.S. So in
Okay.
addition to all the dollar debts inside the United States, there's that large shortage, like that large debt outside the United States.
Right. So
Um,
when you say that there's a dollar shortage, basically it's pretty simple. You've got XYZ company outside the United States that earns their revenue in, let's say, Colombian pesos, and they have a loan for $10 million,
yep.
and they need to literally find dollars to service that debt. And if there's a shortage of dollars out there, it just means there's not enough dollars to go around for everyone to pay back their debts. Is that kind of the way it works?
Exactly, and yeah,
Okay.
for many countries, because they borrow in currencies that they can't print. So even at the sovereign level, they can't necessarily bail out their own companies if they also can't get access to dollars. And
Right.
for a couple of the countries, it's actually not even the corporate level; it's the sovereign level that has the debts. So some
Mm.
countries like Argentina, the debts are at the sovereign level, whereas for other countries like Turkey, it's at the corporate level.
Okay. Okay. Got it.
So the issue is there's all that dollar-denominated debt, and that's an artifact of the dollar being the global reserve currency for the past 50 years, and even before then, if you go to the pre-1971 system. So for decades of global reserve status, there's so much international trade, commodity pricing that all happens in dollars. So many countries borrow in dollars. So there's all this just 12, 13 trillion dollars in debt outside the United States, it's all denominated in dollars, and they're reliant on being able to get dollars to service that, and there's just a shortage of them, especially
Got it.
when in this environment with it was already a problem for the past several years, and that's part of why we've had kind of slow growth. Um, but this crisis obviously brings it all to a head because trade is now greatly reduced, commodity prices are lower, so many companies suddenly can't get dollars, and it's more acute than it was over the past several years.
Let's move on to the core of the one report which I loved, where you're talking about creditor nations versus debtor nations.
Yes. So creditor nations, that's measured as the net international investment position, which is how much assets that people in that country or the government itself, but the total assets that that country has in other countries. So, for example, Japan owns a lot of assets in the United States and other countries. And then other countries own some pieces of Japanese assets. They could own Japanese stocks, they could own some Japanese real estate, some bonds. And the net international investment position is the difference between how much they own from other countries versus how much countries own of their assets.
Got it.
So a creditor nation owns more foreign assets than foreigners own of their assets, and a debtor nation is vice versa. So some of the largest creditor nations are Japan, Germany, Singapore, Switzerland, Norway, Saudi Arabia, Taiwan, and then some of the biggest debtor nations. The United States is the largest absolute debtor nation, but then there's also, as a percentage of GDP, we're one of the worst, but there are some that are even worse, such as Spain, which is deeper in the, the debtor hole.
Okay. All right. Got it. So how does that balance sheet, if you will, play out in terms of the strength or weakness of the dollar?
So in the short run, it can strengthen it because there's no, like I said, there's no dollars getting out there. But it also makes it so that in the intermediate term, it's the United States' problem that the dollar is so strong, because uh, if all those foreign nations can't get dollars, a lot of them, even though they don't have dollars, they do have treasuries, and they
Right.
do have other U.S. assets, including stocks, corporate bonds, real estate. So if some of those creditor nations have to start, they have a more acute need for dollars, their central banks can sell treasuries to help try to bail out their corporate sector.
Right.
And some private, pensions or other institutions might have to sell U.S. stocks, U.S. corporate bonds. Some householders that are in trouble might have to sell, like, say, U.S. real estate or other holdings that they have. And currently, the numbers are that the net international investment position for the U.S. is about negative $11 trillion. So we own 29 trillion foreign assets, and foreigners collectively own about 40 trillion of our assets. So there's an $11 trillion hole that we have.
So any of these assets that we're selling that are denominated in dollars, most likely that could put pressure or downward pressure on the dollar because you're just creating more supply. And then with treasuries more specifically, though, if you're getting a lot of treasuries that are being sold into the market, that potentially could lower the price, increase the interest rate, which would cause a lot of problems for the United States government and our local domestic economy. So that's kind of where the Fed has stepped in. Is that correct?
Yeah, so a lot of their recent, it's called the alphabet soup of different programs they've done.
Yeah.
They often explicitly cite the Treasury market as the catalyst for them doing it. They keep citing how it's been illiquid, it's been very disorderly, and in mid-March, it crashed pretty significantly, the Treasury prices. So if you look at TLT, at one point it was down about 16% from its highs. And all those long bonds crashed pretty hard, and that's because there was so much foreign selling pressure. And some domestic hedge funds and other institutions also were net sellers due to leverage. But foreigners specifically sold over $100 billion worth of treasuries in a very short period of time. And historically, this happens when the dollar strengthens, because suddenly, it happened back in 2016 when we had that global slowdown. We had recessions in several countries such as Brazil, Russia. We had the oil price reduction, and we saw the same dynamic there. So the dollar spiked, the Dixie went up to like 103, 104, and we saw foreigners unloading treasuries to get dollars.
Okay,
And
so why does the dollar going up in relative to other currencies, why does that increase more demand for dollars?
Because when it's going up, it's indicative of a dollar shortage. So it's kind of a self-feedback loop. So it's going up partially because there's a shortage of dollars, and then the more it goes up relative to local currencies, the harder it is for them to get dollars.
So the dollar index going up is more of a symptom of what's going on, which is creating the need to sell the treasuries.
What they're trying to do is not have to buy almost the entire treasury market. So they're buying hundreds of billions of dollars in treasuries per week now. But some of the other measures that they're doing are to try to make it so they don't have to buy as many. So, for example, they're doing currency swaps, so they can give dollars without necessarily exchanging treasuries. It's a loan. And then they also now have an international repo. So foreign central banks can loan their treasuries back to the Fed rather than sell treasuries on the open market in order to get dollars temporarily. So the Fed would prefer that than all this outright hard selling of treasuries.
Right. It seems to me like the Fed's just trying to get as many of these assets on their balance sheet as they possibly can, so there's fewer sellers and just to prop up the prices. Do you see it that way as well?
Well, yeah, basically there's not enough buyers for all the sellers, both international and domestically. So the Feds find themselves as, instead of the buyer of last resort, they're becoming like the only major buyer of treasuries. Of course, some traders are of course buying, but the only buyer at scale right now is the Fed. They're buying, they're the major buyer, and they have to do that because there's just not enough dollars, not enough buyers to buy all those treasuries. But then they don't want to just keep it going at this rate because they don't want to buy the entire treasury market or the entire international treasury market. They'd rather provide some of these loans to bridge the gap until hopefully they get trade back up, and then foreigners are under less pressure to sell treasuries. They want to not buy more than they necessarily have to.
Yeah, what are the downsides there? I mean, I think I understand them, but for the audience, what would the downside be of the Fed just buying the entire treasury market? Then problem solved. You don't have to worry about interest rates. We don't have to worry about all these pesky sellers.
Oh, in the long run, it's results in currency devaluation most likely, because the dollar actually has a lot of fundamental problems with it at the moment. Like it's overvalued based on a lot of metrics. So as you relieve the dollar shortage, on the other side of this, there's a pretty good likelihood that we're going to see a weaker dollar, and then you open up the can of worms for inflation and other consequences like that.